So, without further ado, I would like to welcome you to the 5th Berlin Green Investment Summit on behalf of the Global Impact Investor Family Office Network TONIC, whose motto is less talk, more action. So I try to be short as I introduce everybody. The Institutional Investor Group on Climate Change, whose members today manage $30 trillion, an amazing growth over the last years. The German business network supporting the Paris goals, Stiftung 2 Grad, which has been founded by Michael Otto, one of Germany's legendary entrepreneurs, and our Jeff Bezos. The non-partisan climate action initiative to get Germany to zero emissions by 2030 or 35, the latest German Zero, and the family office and impact investing advisor, Wermut Asset Management. Thanks to Corona, we are meeting online, which much less CO2 footprint and much more time for action. So please enjoy your cup of tea and your scones, and we shall meet again at 4 o'clock every last Thursday of each quarter until the Corona crisis is over or climate change is reversed. The next time we'll meet on the 24th of September. We will try to set up a LinkedIn group to allow us to work together effectively after this meeting as well. We want you all and us and me to get a max amount of relevant new information, have the opportunity to participate in breakout sessions and to ask our excellent speaker panels questions so we all get jolted into action. One always asks ourselves, can we make a difference, yes or no? I'd like to quote Margaret Mead here. She says, never doubt that a small group of thoughtful, committed citizens can change the course of the world. In fact, it's the only thing that ever has. We need to partner up to really tackle climate change. It is far greater threat than Corona. We need to refocus on climate change, the human rights issue of our time. The International Energy Agency and international renewable energy agencies have estimated that we need to invest $1 trillion more per year over the next 30 years to reach the Paris goals. So the climate finance gap is $1 trillion a year. That sounds spooky at first, but actually it's almost nothing. It's 1% of global GDP, or for an average OECD citizens, it's an investment of 500 euros a year, or the cost of a better bag. And it is an investment, as we will see, that will offer outstanding returns. Also, on the EU current accounts, the cash accounts, we have 16 trillion euros. The global financial markets are 200 trillion euros. So 1 trillion is just 6% of what we have on EU savings accounts. It is 0.5% of what we have on global financial markets. If we use that 1 trillion and leverage it 5 times and recycle it 6 times, we're at 30 trillion. So it's really a tiny amount of money that needs to be moved. Let me make 4 short points before we move to the introduction of our speakers in rapid fire. So Project Drawdown has shown us that there are outstanding solutions that actually save us money and reduce climate change. The biggest are, of course, solar, wind, and the likes, but education of women, uplifting women out of poverty is a very, very important point as well, ranking number 6. So many solutions are available to abate climate change. We've also seen outstanding results. Al Gore and David Blood set out to set up Generation Investment Management in a perfect storm in 2006. Today, they've delivered some of the best performing long-only performance in equities. Long-term divest invest, long-short strategies have performed 10 to 20% per annum. The Sovereign Wealth Fund of Germany has far outperformed the market on the way down in this crisis by excluding oil and gas from fracking and open pit coal operations and focusing on sustainable investment opportunities. This is a way to make money as well as doing good. We will see an example today from Gilbert Fritzberg about his hydropower fund, which will cut 100 times CO2 emissions compared to EU average and deliver an 8% return. We have citizens and pension and insurance companies all earning almost nothing. So climate solutions offer good returns and they do good for the world. There's almost nothing we need from politics except for a proper CO2 price. I like to say the current stimulus is like feeding headless chicken. To throw corn at headless chicken is pointless. To throw billions at an economy that does not price the CO2 price at its externality is pointless. The German Federal Environmental Agency has estimated that 1 ton of CO2 emitted today causes 640 euros per ton in damages in health and environmental damages. Now, we've been asking for this for a while, but we have great backing now from 27 Nobel Prize laureates who call for a CO2 tax reflecting externalities, a border duty to avoid the import of CO2 from other countries, and the redistribution of the income from this tax to the population per capita. This means that if you drive 5 SUVs, you have to pay a bit more. If you consume on average, you will pay as much CO2 tax as you get back in CO2 dividends. If you consume less, you actually get cash as a result back. This is a socially just way to go forward. This is what we need to move in our little villages, cities, regions, states, governments, countries, and the EU and the world. We're also happy that the European Union under the Green New Deal is moving forward. We'll hear more about that from Laurence Toubiana, who led the Paris negotiations on behalf of France. And we also know that in spite of the huge amount of capital out there in the world, there's a major shortage of risk capital. There's not enough money to get the key companies for which we have solutions, be it the Mobility House in Munich, where Alexander Landia joined us today, which can double the amount of CO2 savings from moving from a combustion engine car to a electric car by using the batteries as storage capacity. So we need for that blended finance, to which Astrid will speak. Without further ado, I will now move to the introduction of our panelists. We will start, as mentioned, with Laurence Toubiana, who is now the CEO of the European Climate Foundation and the chair of France's Development Bank, and has led the Paris negotiations on behalf of France. She will be supported by her lead, her director of climate finance at the European Climate Foundation, Astrid Manroth, who will be followed by Peter Damgaard Jensen, the president of the International Institutional Investor Group on Climate Change, in turn followed by Philippe Desfossés, who ran France's largest 40 billion euro pension fund, outperforming other pension funds in Europe by 25% by focusing on climate solution and sustainable investments. And finally, but least and not last, Dr. Gilbert Fritzberg, former member of the Austrian Parliament, from a family tradition of hydropower, who will give us a concrete investment example. After this set of speakers, we'll go into breakout sessions where we all can talk to each other, get to know each other, find the action we want to take. We'll be brought back to the main room, we'll have a discussion, and the panelists will be able to answer questions at that point. Without further ado, I would then ask that we get our message from Laurence Toubiana, who's been called to see the President of France. As you may know, the Convention du Peuple sur le Climat is taking place in France, and therefore we have a video message from Laurence produced right now. Alina, over to you with this one.
I am very happy to have the opportunity to say some words before your Berlin Green Investment Summit 2020. I'm very sorry not to be able to be with you, but I am presenting the result of the Citizen Assembly for Climate that took place during these last 9 months, and we present the result these days to the National Assembly and to the President of the Republic. I do think your summit comes at a critical juncture. We have now quite a clear framework, the Green Deal, to orient and to drive the recovery plans that have to take place and are taking place in all countries of Europe now. And we know that mobilizing the entirety of the financial community is really central for this Green Deal to happen in real. There are good things we see happening, in particular a new solidarity between European countries, a massive boost of cohesion funds. We have a solidarity that expressed that the more impacted countries by the crisis of coronavirus will be more supported. And we see as well that there is a fair share of grants and not only lending in the next gen EU. So there are good things, and there are of course some things that doesn't necessarily drive these recovery plans towards a real green and some orientation of the economy that allow the European economy and society to get to net zero of emissions in 2050. So that's why the messages, the mobilization of the climate financial community is central to, in a way, keep on track this evolution of the European economy. So, in my view, it's a historical opportunity. Both the European Parliament, the Commission, and now many member states are pushing in the same direction. We see even the more reluctant government on the financial side that really requires that this funding with the collective cohesion fund goes really for greening the economy. So that's really positive to see such an alignment. But we know that this public funding would only deliver if the private finance comes in and if there is an efficient leverage of the public funding to the private one. So it's really important that in your summit you see how the institutions can in a way take that opportunity and accelerate that trend, both at the European institution like the European Investment Bank, as well as the national banks, as well as, of course, the central bankers, and of course the different pension funds and all the institutional investors. So I recognize the importance of your action, and I think the message you will send through these days will be very important. So I thank you very much to allow me to have some connection, at least indirect. My good colleague, the finance program director of ECF, Astrid Manros, will be with you. I really want to be kept in the loop because I do think that will be a very important driver of the change we are looking for, and there are many obstacles. And again, thanking in particular Jochen Vermut, the founder and CEO of Vermut Asset Management, to have offered to me that opportunity. And again, sorry not to be with you physically, but really I'm with you in the thinking. Thank you.
Thank you very much. And we turn to Astrid then, yes? Astrid, over to you.
Yes, thank you very much, Jochen. Can you hear me?
Yes.
Okay, perfect. Yes, so building on what Laurence, my CEO, just said, I just would like to share a few thoughts with you on how we can finance a green and sustainable recovery, which at the ECF, as Laurence said, we believe should be done in the context of accelerating the EU's Green Deal. As you know, the new Commission President von der Leyen has made great progress in terms of enshrining Europe's climate ambitions into law through the Net Zero 2050 climate law. And the Green Deal really is providing the blueprint how to achieve this. At the same time, like Jochen said, at the global level already, we are facing a significant investment gap. So the pre-crisis Green Deal investment needs are estimated at 260 billion euros per year, and this was pre-crisis. And if we're adding the investment needs resulting from the crisis impacts, we're really looking at trillions. So to give you an order of magnitude, the new proposed 7-year EU budget alone is amounting to 1.1 trillion, and the new proposed EU recovery instrument, which is the so-called Next Generation EU, is proposed to amount to 750 billion, all of which is meant to be raised from capital markets. So it's very clear that these orders of magnitude cannot be achieved by the public sector alone, and we really need to together increase our ambition to leveraging in private investment for climate finance. And I would actually say that the opportunity for collaboration between public and private finance has never been more urgent, but also has never been more promising, echoing what Jochen said in the beginning. So what is the role of private finance in ensuring a green and sustainable recovery? I briefly would like to touch on 4 points in this area. 3 points of what investors can do externally, and 1 point of what you can and should do in-house. So the first one is really investor voices are very important in calling for the right government strategy and framework. And I would like to very much thank you and IIGCC, UNPRI, CDP for putting together the very impressive open investor letter calling for a green recovery in Europe that came out, I think, on June 8 or 10, if I'm not mistaken, where a very strong voice of investors representing 12 trillion in assets under management was calling on governments to make sure that we are rebuilding better in a low carbon manner. Similarly, the statement that was facilitated by the 2 Degrees Stiftung in Germany ahead of the Petersburg Climate Dialogue was very powerful in that context. The IIGCC facilitated letter also called for investor participation in national recovery plans, and there are very concrete opportunities for this as the EU is linking their budget and recovery support to national recovery plans that have yet to be developed, and there is specific support foreseen to regions that are facing structural transitions under the Just Transition Plan and mechanism, which also requires the elaboration of such plans. And last but not least, at the strategy level, of course, investors can really help support the identification of investment opportunities as part of these recovery plans, but also highlight the obstacles to policymakers that have to be overcome to make them bankable. So for your information, ECF at the moment is supporting work by EY across Europe to identify a list of up to 1,000 shovel-ready green projects that can be brought to policymakers and investors to highlight really the opportunity that we're having at the moment to rebuild better. Secondly, of course, investors have an important role in the current context to ensure that the right policies are put in place, not just to spend the stimulus right, but also to create the frameworks that will enable green investments. So in terms of spending the stimulus right, just to give you a bit of a flavor of what we're discussing in Brussels at the moment, we very much would like to see that companies benefiting from bailout funding under, for example, the new EU solvency instrument, they really have to commit towards net zero transition plans in return, so that they are starting the transition towards a low carbon portfolio. We also would like to see a credible exclusion list or do no significant harm approach across all the stimulus investments, and on the positive side, a minimum percentage earmarked to climate action. And we very much support the application of the EU taxonomy that you will have heard about, because it gives a first categorization and understanding of the current investment level in green categories. And of course, investors need to continue to tell the government the kind of sectoral policy frameworks and incentives that are required to enable investments by reducing policy uncertainty and also addressing investor risks. And in the context of public funds being made available, I believe an important area of improvement is also to accelerate unbureaucratic access to these funds. As you know, a lot of the EU funds that can be paired together with private investment, for example, under the InvestEU mechanism, are accessible through rather lengthy processes through EIB. This needs to change, because if we want to realize the sustainable jobs of the future, basically tomorrow, we have to be able to have the financing ready today. Third, I think from an investor perspective, there are very nice opportunities to call for and also structure and invest in innovative financing instruments. And in this context, I just would like to echo Jochen's point. We have enough studies and data out there to say that there is really no trade-off between impact and return. So investing in climate is good business, and any other notion can be dispelled. In order to scale up that good business, a number of factors can be put in place. One, we need, I think, increased project preparation capital and development capital to really bring more investable green projects to a bankability stage more quickly. And this is, in my view, one of the key bottlenecks, and we're working with the EU and the EIB and others to hopefully help address this. Similarly, technical assistance funds under existing and new plan facilities need to be scaled up. And then in terms of financing solutions, blended finance, leveraging public finance to crowd in private investments can play a significant role in this context. And I think amongst this panel, we have enough very good examples of this, how this can be done. To give you just one example from my time at Deutsche Asset Management, we were managing the European Energy Fund, which had a first loss tranche from the European Commission. So this is the so-called C shares, or the risk capital that absorbs losses. And that was sized at 30% of the total value of the fund. And then there was a mezzanine tranche where Deutsche Bank and development banks were investing themselves. And investors like yourselves could then invest in the senior equity tranche, and some of the funds we managed also had a debt note product on top of this. And there are good variants of this that others can also speak about. For example, Denmark has done a very good Danish climate fund with a minimum use of concessionality to crowd in a maximum of private investment. Or in the Netherlands, the so-called Climate Investor One fund structure is a range of 3 interconnected funds, whereby you have a development fund, a construction equity fund, and then a refinancing fund for operating assets, which is an interesting way of chopping up risks along the project cycle and allocating them then to public and private investors that are best positioned to bear them throughout the project cycle. And of course, in the context of capital markets issuance, green bonds are becoming increasingly mainstream, and they, in my view, are also an instrument that can be leveraged for post-crisis finance. I very much would like to see the EU issue a green recovery bond as part of this capital markets package I mentioned, but also companies can think through issuing transition bonds. There's a lot of space for results-based finance. The IFC at some point has developed the concept of a Breathe Better bond that improves air quality in cities, for example. And last but not least, in the context of highly indebted countries, this is probably more an emerging markets and developing country topic, there are also opportunities for innovative structures such as debt for climate conversions.
Excellent.
Thank
you. Yeah.
Okay, you have to stop me. Can I just say one more sentence?
Please, you can, yes.
So these are all the asks investors can put to others, but I think it will also be good to start the transition at home. And that, of course, includes the need to work on Paris alignment in the own portfolios by setting targets, but also by applying forward-looking methodologies and disclosing and reporting on climate risks and opportunities in the portfolio. And secondly, then also working with investee companies to enable their transition to net zero as an engaged shareholder and investor, also asking them to set targets and strategies and report on them. I will shut up now. Thank you.
Super, thank you, Astrid. Okay, with that, we turn to the famous Danish that we just mentioned, and Peter, who's been a leader of the president of the Institutional Investor Group on climate change and running the successful PKA for the last decades. Peter, go ahead.
Thank you very much, and thank you for holding this seminar. I will start with the question that just was given by Astrid, and to tell that in IIGCC we are actually working with, for the moment, how we can create Paris-aligned portfolios. And one of the things we have found out positively is that there's a great interest among our members to take part in that work. I think there's 50 plus of investment of investors out there that's part of the work. It will take some time, but it starts to build up knowledge so that we actually know if our portfolios are Paris aligned. The other thing I would mention is that we in Denmark have started an initiative to show that we as investors are able and have the willingness to go into the green investments. Last year, the Danish pension fund announced $50 billion would be invested in the green area before 2030. That's actually 10% of the Danish pension under management. And if the rest of the world did that, we might solve the trillions, and we'll try to build that up also through IIGCC with our colleagues around Europe. Then a short notice of my past experience. PKA have built up a green portfolio that today is 3 billion euros, mainly in renewables. And it has been the best asset class during the Corona crisis. Even when equities were down with 20 to 30%, it had a positive return. And the return today for the first 8 years is 10% plus. So I can really say that practice shows that doing green investments,
right?
per annum, not annum, per annum. No. So all in all, I think we can, in a few years, we can pass the discussion that investing green is sacrificing return. If you do it right, it's the other way around. Then on politics, I'm quite positive on what's going on in Europe, and thank you for mentioning the letter we have sent to the European Commission. We want to push for Europe to be even more ambitious, but I actually think that Europe is one of the regions doing more. I think we have a bigger problem when we talk about the G20 and the G7, but we as investors will also push there, because the problem with Europe, of course, is that we only have 10% of the emissions. But I still think that Europe, by going in front, can show the rest of the world, and we as investors can show that it's actually good business. And I know at least a part of the developed world where good business is something one knows. So we will keep on pressing for that green investments is part of the solution, also on the COVID crisis. Thank you very much.
Thank you, Peter. With this, we turn to your former deputy, Philippe Desfossés, who's been running the French pension fund ERFP, a 40 billion vehicle that has outperformed, as I mentioned, the European average by 25% by being sustainable at times when people thought that he was completely out of line. So thank you, Philippe, for holding up the flag and sharing with us your thoughts on what the future could look like for long-term investments.
Well, thank you, Jochen. I would like to start by reminding 2 points. The first is that pension funds are expected to play an increased role in financing the transition. Second, that we need to provide them with a framework and products that would allow them to play their full role as long-term investors in the financing of the transition. Until the systemic change of unconventional monetary policies, it was recommended to deploy a so-called 60-40 allocation, allowing therefore a predominant place for bonds. It is that frame that is gone. Central bank quantitative easing policies have pushed much of the public debt of the Eurozone countries into negative territory. Pension funds' oldest bonds in portfolio are coming to maturity. They were issued at much higher rates than what the market offers today. What are the pension funds to do with the repayment of these bonds? Can they keep on investing in bonds that, upon the issue, guarantee them a nominal loss? In this regard, and as another driver of change in their asset allocation, it is necessary to integrate the demand of younger generations to know what their contributions are used for. They are not only concerned with the coverage ratio of their pension funds liabilities, they also want to know if the investment of their contributions helps to finance a transition that is vital for them. If the 60-40 allocation no longer works, what can we do? Where can we find inspiration? A quick search confirms the need to adopt some of the investment approaches of the endowments. This includes the acceptance by the governance of pension funds to free themselves from their addiction to liquid assets. There is an urgent need to bring out players capable of providing pension funds with a means of investing in unlisted assets that will finance the transition. In a very uncertain world, there are still a few issues that are not likely to be discussed. One can quote the need to combat deforestation and develop sustainable forestry management, promote agriculture that provides healthy food to a growing population while contributing to carbon capture, build the infrastructure needed to store and distribute renewable energy. Actors like the climate endowments are convinced that institutional investors, governments, as well as political authorities should mobilize the patient capital of pension funds to get it invested where it is most needed. In this regard, it is possible to tell you more about two themes for which it will soon be possible to offer institutional investors investment support. The first relates to run-of-river power plants. Often small, they do not have a strongly negative impact on the environment, as it is the case with the large dams. The Climate Endowment is working with a well-known player in the sector to present a fund to the investment by the end of the year. The second is a highly symbolic asset, forestry. Forestry is the asset that epitomizes the sustainable challenge and what long-term unsustainability mean. This is even more true today since well-managed forestry is one of the most efficient carbon sinks. Climate Endowment is working with a team of seasoned professionals to be able very soon to propose an ideal investment product for investors ready to invest in forestry, which is a real asset with great diversification potential, an asset that delivers sustainable and satisfactory return, and value of which is not correlated with that of the financial markets, and at last, an asset that reflects their willingness to do something concrete and very efficient to combat global warming. And now maybe Gilbert can tell us more about the possibility to invest in hydro in order to reach a good return and also to have a great impact on carbon.
Thank you, Philippe, and go ahead, Gilbert.
Well, hi everybody. Thank you also from my side. I'm working in hydropower for a very long time, and my family is in hydropower even now for about 180 years. I would like to give you run-of-river hydropower as one possible investment to help close the climate finance gap. Hydropower supplies the largest part of renewable electric power in the world, with a share of about 62%. It is a major technology, and at least in Europe represents a rather safe investment. Run-of-river hydropower does not require a dam blocking and flooding a whole valley. It seems to be easy. You take the water, let it pass through a turbine and give the whole water back to the river. In fact, it's not that easy, of course, because we have to pass through remarkable license questions, care about not to harm environment like fish and biodiversity, and last not least, we have to dig the money into the earth in the construction phase. But once operating, we have very low operating costs, only have to deal with depreciation and interest, and can expect an operating lifespan of up to 80 or even 100 years and relatively stable income. Up to 100 years of almost no CO2 emission also leads to less than 1/100th of the CO2 footprint compared to the average of the EU power industry, 1/100th. By creating a diversified portfolio of brown and greenfield, mid-sized hydro investments, mainly in the EU and Norway, risk is further reduced through diversification. One should be able to generate both 3% per annum cash out and achieve an IRR of about 8% per annum. Such a high return is possible due to the fact that we invest in smaller projects than large investors look at, due to illiquidity and due to a large team of experienced engineers who can evaluate projects and refurbish them for maximum return. The fund should be available for professional investors in July 2020. We welcome private, family, and especially institutional investors to pool 1 billion of assets. That's it. Thank you.
Thank you, Jill Gilbert. Thank you very much. And before we go into the breakout session, my wife has said we should at least cheer up a little bit. And here we go. In case you didn't know this climate joke yet. So climate change is all a joke. Even the Antarctic ice shields are cracking up. Right? Okay, very funny, I hope. With this, let's move to the breakout sessions. Please quickly introduce yourselves. What motivates you personally to stop climate change? What action you can take, what your institution can take, and what you would like to ask of the panel. Please appoint a spokesperson if it hasn't been pre-appointed. And we now get a message on your screen to click, say yes. Please go ahead and invite people to the breakout sessions. Click join and you'll be in there, and you'll be kicked out with a 1-minute warning in 10 minutes to join back the big room. See you soon. Okay, welcome back, everybody. I hope you had great breakout sessions. Ours was amazing. And I think we should start with the first rapporteur. We can maybe start with Johanna von Ritter. Can you mute yourself and go and ask the panel or report and
Greetings, everyone. I had the pleasure of being in a group with Jochen, our moderator here, and Ashwin. Jochen, you know quite well already through this session. It was fascinating to hear about his motivation starting from nuclear radiation-related health concerns and migrating that to climate change. Ashwin, on the other hand, is coming from a different angle. He is working with an electric utility in Kansas that still has coal assets and is leading a venture group to help this electric utility migrate to the next green economy. The action steps, and I am working in impact investing, helping family offices and foundations allocate to impact-oriented investments.
And currently in Costa Rica.
From Costa Rica, exactly. Action steps that we are looking to take to close the climate finance gap. Jochen would like to build out an asset management firm and is looking for partners. So if anybody here in this group is interested, I know, a bit of a joke. Ashwin is investing VC into energy, clean tech energy. We had a great idea from Jochen for Ashwin to consider the thermal drilling to transform coal plants to deal with the massive stranded asset issue. And I would like to make a call for spending more time, energy, and capital on nature-based financing solutions.
Super, thank you. Move on to Joseph Abramovich.
Hi, everybody. So we had a great group and very action-oriented. It was with Manfred and KJ. Manfred was talking about needing to fund transition technologies now. He's invested in only public companies, but one of them, I was a little dubious, but he convinced me because it relates to diesel. But it's a gizmo that you can put right into a diesel truck, and it will lower the emissions by 20% instantly. And so they're growing very quickly. We did talk about for listed companies on doing green. Maybe there should be some sort of guarantees for a certain amount, like the British government is about to do. PJ works in Africa like I do. And the normal fund structure is like 7 years, but in Africa, we found out things always take forever. And so, you know, instead of using a Western solution on financing, maybe have 10 and 15-year funds to be able to do that. And folks, as one of the speakers said, we need more project preparation financing. I actually don't think that there's going to be a shortage of climate finance if there's project preparation funds that are available, easy to get and to do quickly, because these are great IRRs and these are annuities. Guys, I hope I got it right.
Thank you, Joseph. And you are sitting in Tel Aviv?
Jerusalem, beautiful city,
Jerusalem.
Apologies,
no offense intended.
It's fine. And I did the solar industry in Israel. Now we're doing it in Africa and with Palestinians.
Well done. Okay, Kimberly, I see has a hand open. Is Kimberly there? Yeah, go ahead.
Yeah. Hi, everybody. My name is Kimberly. I work at a startup in Stockholm. We work with energy transition mortgages in Sweden. I was accompanied with a team from, I hope I say this right, Synthesis Analytics, who is also working on developing new financial investment opportunities, financial products, I should say. And also Kurt Leutenegger, I think, who I think I understood was a member of Tonic and works with family offices. I hope I got that right. And we spent most of our session talking about the challenges of being a new green company. Investors often put a lot of requirements on any sort of investment. It should be liquid, it should be rated, it should be listed, etc. And those types of hurdles are of course challenging for a new company, but also for a new financial product where the rating agencies may not have a good methodology developed. So I don't know if we do questions to the panel now or later.
Please go ahead now. Yeah.
Because, no, I think our question was, I think we all agree for the need for kind of new financial instruments, such as blended finance or transition funds, or something I heard today for the first time, results-based bonds. The question is, can large investors, particularly pension funds, are they able to change their mandates quickly enough? Because it seems that it takes quite a long time.
Excellent. Do you then quickly want to go to the panel for the reply? Maybe Peter, do you want to reply to that? Peter, you may be muted. Yeah, you're unmuted now. Yeah.
Yes, I agree. In pension funds, sometimes we have a long investment process. But when there is an opportunity, and then we of course can on beforehand say that we will allocate part of our investments to that area. What I think still is needed now, if I look at pension funds in general, is a bigger awareness on climate and impact investing. A lot of pension funds have really done nothing until now. So they have to dip their toe and get into it, because investing in this area is not just something you can sit and do by your desk. You have to be out there and try it and find out what's good investments and what not so good investments. It's not only I mean, like everything else, you have to have your own experience.
Thank you, Peter. My master here says we should be wrapping up, so we ask, is there any other urgent question in the whole group, the panel, that we want to, so we don't miss it? Please speak up, you're welcome. No, okay, then we would probably move on to Philippe, maybe to the round of closing comments, the reverse order, basically Philippe, Gilbert, and Astrid. What actions should we take, Philippe?
For the sake of time, I will just rebound on what Peter just said. I think that unfortunately, the missing point is the change of mindset that is needed both from the governance of pension funds, but on top of that, also the change in the regulation. The regulation has been treating investment in infrastructure like, you know, if you were investing in the most risky of all assets. And just to give an example, at some point, if you were investing in Greek debt, no offense for Greece, you know, it was supposed to be a risk-free asset. when investing in a no-nonsense infrastructure project that will deliver for a very long period a sustainable cash flow was deemed to be very risky. So I think that altogether we have to convince the people who are in charge of regulation that for pension funds that have very long-term liabilities, it makes sense to match these liabilities with investment in assets that will deliver sustainable cash flow for a very long time. It's not risky as it is deemed to be, because there is a misconception to assimilate risk and volatility. And once again, pension funds are very long-term investors. They have a clear idea of their liabilities. They can calculate the duration of those liabilities. You cannot go to your pension fund and say, I want my money back. So volatility, especially calculated on the basis of a value at risk on an annual basis, does not make any sense. We all know that. We have been asking for years that to be changed. I hope that we will manage to do that. And it should be a contribution.
We will. And you
to funnel more money to investment.
Excellent. Thank you. Thank you. Gilbert, what's your action point to move more capital? You're already on it, yes?
Yes, I'm on. Thank you. Well, I'm used to invest, so it's just another stage for me, and I'm experiencing investing in hydropower. There's one thing in renewable and in electricity market you should really take into account. The more we come to renewables, the more you need answers for the storage question. The more you have solar, PV, and wind in renewables, the more you need storage. At the time being, hydropower is the most mature technology at answering to this question, because batteries and all these questions are not really mature so far. But I think you should take into account that we have a mixture in the future, a diversity of different renewables that will solve the part that counts for electricity. And don't forget, electricity will move up to about 40% of the whole energy demand. And that will need a lot of investment to be able to solve the questions coming out of it, especially also in the grid. So you need a mixture, a diversity of investments to really get along. And I'm sure that hydropower will be one of the needs, and will have a good future for a long-lasting time compared with real estate. And I think we are in a good way. We need to start.
Thank you, Gilbert. Excellent. And ladies last on this occasion, Astrid.
Yeah, thanks. I'll be very brief. So my favorite action item would be that every investor on this call adopts a climate finance target. And we will continue to work with the authorities to put the enabling policy environment into place. I think if you all adopt targets, we already have increased the amount available to financing. And then if we fix the project preparation question, we should have perfect symbiosis. Thank you.
Thank you, Astrid, and thank you, Kristin. Thank you, Alina. Thank you, Sam. Thank you, Alina, Natalia, for organizing this wonderful event. Very short and brief. It will be available for recording so we can share it. And I hope to see you on the 24th of September for the next version with another set of great speakers and panelists. Thank you very much. And thank you for making a difference. We will make a difference. We will make huge solutions. Just to spell out one more time, the two great companies we mentioned was Geothermal Anywhere Drilling. We had Yair on the call, and the Mobility House, which uses the car batteries for storage. But okay, this is just concrete people that worthwhile supporting, I think. Thank you very much, and let's move forward. Thank you, and let's set up this LinkedIn group so we can all work together and think of ways of moving capital quickly. It will be done. Thank you. Have a great day. Bye-bye.
Bye-bye.
Bye.